Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending September 27th, 2024. I'm Preston Brent. Thanks for tuning in. Well, very interesting week this week. Our theme this week is last week China was the Feds were all in. This week China's all in. If we take a look at the markets, just barely above zero. The Russell slightly in the red, but year to date everybody's doing very well. But we did see new record highs in the S&P and the Dow. The week's economic calendar also appeared to drive some market sentiment as equities pulled back just a little bit on Tuesday, with U.S. consumer confidence falling a pretty good bit in August. And we did get the Commerce Department on Wednesday talking about new home sales declined 4.7% in August. Also, building permits were revised lower as well. But one of the main drivers so far of the U.S. markets is the rate and speed of the Fed interest rate cuts. Now, keep in mind, we're going into the month of October next week, and the VIX typically averages around 22. September and October do not tend to be kind to the S&P. We were up a little bit in the month of September, but I think October will be a little bit different. You can see the PE ratio. The forward is about 2% less than the trailing, but still, in my mind, very, very rich. I don't believe earnings expectations are going to meet up to these PE ratios. So longer term, we're going to see the market slow down going into 2025 or through the rest of this year going into 2025. Earnings yields at 4.6%. You can see the S&P yield over the 10-year Treasury is about 85 basis points. The VIX closed up for the week. I thought it was really interesting that on Friday the S&P was only down about 4 or 5 points, but the VIX moved up a good deal. Over 1.65 in the VIX, which is unusual. So that tells me the VIX is very sensitive right now to any type of volatility increase. So we need to watch that for the week. You could also see the best performer for the week, no doubt, was materials, primarily because of all the stimulus going on over in China. Materials loves that. Metals, industrials, those kind of things, they love that. Healthcare was the worst performer. Year to date, utilities, almost 30% year to date. Totally amazing. Energy also bringing up the rear, but in the green for both, for all sectors for the year so far this year. Okay. Um, if we come over and just look, we did get on Friday the PCE, the personal consumption expenditures. That's the Fed's preferred inflation gauge, and more specifically, their core. And that rose only 10 basis points in August. So slightly below expectations on a year-over-year basis. It came in at 2.2%. And remember, the Fed's long-term goal is 2%. So they're just about there. So like I've been telling our members, inflation, unless we get any major surprises, is pretty much in the rearview mirror. And all activity now is going to be focused on jobs, right? And we're going to get a big jobs report coming up this coming Friday, the first Friday of October. So that has a capacity to really move markets. Okay. We also got, let's go take a look at the Eurozone here and just kind of see how the market shaped up there. Everybody was in the green all across Europe year to date, not as strong as the US. However, business activity in the Eurozone shrank in September. And it fell on new orders, new business orders. The PMIs compiled by S&P showed that the output index fell to 48.9 from 51.0. That's contraction territory for Europe. Services also came close to stalling as well, and we're seeing that boost that France got from the Paris Olympics is pretty much faded away. And manufacturing is contracting faster there too. And business morale in Germany in September is very low. So that's adding signs that maybe Germany is starting to slip into a recession. So remember, sometimes what happens over in Europe washes ashore over here. Right now, there's no forecast for a recession in the US that I'm seeing, a low probability of around 30% next year. But we have to be careful. That's why the jobs numbers are going to be very closely followed, especially the upcoming jobs numbers this coming week. Okay. Now, of course, the big provider this past week was over in the Asian markets. If we start with Japan, um, the latest commentary from the Bank of Japan is more perceived as dovish. It kind of weighed on the yen just a little bit. Um, and optimism also came in Japan from China stimulus because Japan ships a lot of goods over to China. So that helped Japan out a pretty good little bit. Meanwhile, after the markets closed on Friday, Ishiba won the Democratic Party's leadership contest. So he's going to be the next Japanese prime minister. And he's viewed as more hawkish, so he may resist Bank of Japan efforts to normalize uh, monetary policy. So that means that'll put a little bit of downward pressure on the yen. And the Bank of Japan governor, Kazu Oida, he basically said that their central bank has enough time to assess market and economic developments before adjusting any more monetary policy. So that suggests near term there's no rush to raise rates any further. A lot of our members made really good money on the yen trade. We got into it. I was having our members get into it about 3 or 4 months ago, and it took off because I could see it's low hanging fruit trade. What I like to say, where the risk of a big move was just so outsized to the upside, you had to take the trade. Now I think there's going to be profit taking, so hedging the bet for those that did take the trade makes sense in the yen. I do believe longer term it will go higher, but we'll probably pull back a little bit here. Meanwhile, the big mover for the week was China. Chinese stocks really took off like a bazooka shot when Beijing unveiled a whole slew of measures to shore up their economy. I mean, the PBOC cut its reserve ratio requirement by 50 basis points for most of their banks. That's the second cut in bank reserves this year. They also reduced their 7-day reverse repo rate. That's a short term lending rate that they give to the banks by 20 basis points. They also cut their medium term lending facility rate by 30 basis points. That's the largest ever cut to monetary policy that we've seen out of China since 2016. Huge cuts. They also came out with measures to a rate cut for existing home mortgages, slashing nationwide down payment ratio for second home purchases to 15%. Now, granted, that's not everybody because not everybody has a second home there, but they're really trying to put a bottom on their real estate market. And coming out of their annual meeting, the Chinese leaders basically vowed to take action to stabilize the country's property market and to stop the real estate prices from declining. So that statement basically said they're going to deploy whatever fiscal spending is needed this year to have their target growth come in at around 5%. So that, in addition to them issuing more sovereign bonds to the tune of about 284 billion this year to help their fiscal stimulus. So, all in all, this week, China just really flooded the market with cash, and it really does affect European and U.S. markets because China is the second largest economy on the planet, and a lot of that money flows everywhere. It's not just contained in China. So that's what really, I think prevented the U.S. markets from finishing in the red this week with that big stimulus package that they came out with. Now, the big question is how long will that stimulus last? And history would suggest short term it may be good. Longer term, the stimulus really isn't large enough to sustainably free China from its weaker growth trajectory. Hang on one second, guys. Let's see something here. Let me just see something here. Hang on just one second, guys. So I'm back with you. So anyway, really crazy markets over in the Asian markets. Now let's take a look at the U.S. markets and see how things are shaping up here. Like I said, October, I would not be surprised. Now I've been telling our members we should expect a pullback, no greater than 5 to 6%. I don't see a large pullback, but certainly in the let's call it 4 to 6% range. sometime in the month of October. You can see my pullback points here, taking us down to 56.63, down to, let's call it 5600, somewhere in this range right here. This was where we had a big gap in the E-mini futures. You can see we're hitting my resistance point here. Intraday all-time high was on the 26th at 21.14%, which is really a 2-year return. Very good return here. You can see there is no divergence in the MACD, very, very little. In fact, this cross here was met on huge volume in early September, just totally opposite of the normal path for the U.S. indexes in the month of September. But now we're starting to see a little bit of weakness coming in here. The price action seems a little bit heavy. It's kind of what I'm sensing here. So if we come down here, let me just get this over here. If we take a look at the equal weight over the SPX, you can see it's been, the equal weight has been keeping up with the SPX. But if we do look at the equal weight index just by itself, you can see I haven't even marked it for Friday. We made new highs on Friday for the equal weight. And again, very minor, if no divergence at all. So that gives us the other 493 stocks, I guess, seem to be doing much better. And this all started coming off the August 5th Japanese carry trade boondoggle that came to an abrupt halt. You know, and with a slight little pullback off the 50 EMA, it really did very well. Okay. And then, of course, if we look at the Dow also made new highs. And you could see here that the Dow was up very nicely, no divergence here. So all of these charts suggest any pullback, which would be normal at this point, is going to be a buy the dip moment, right? And then this will carry us through October, but I do expect some little bit of a pullback. Now, let's see how the markets react to that. And then, of course, if we come down here and look at the FANG index, you can see here with the FANGs, the last time we made an all-time high in this customized FANG index was back on July the 10th. So that tells me that money is flowing out of some of these mega cap tech and into other stocks across the S&P. So that's a good thing, right? And of course, if we come over here and look at the NASDAQ 100 futures, you can see here, again, same thing with the FANG index. Last all-time high was made on July the 12th. So we are seeing some spreading out of money as it comes into the U.S. markets. And if we come down here and look at the VIX right here, it surprised me a little bit with the VIX moving up on Friday. Now remember, Friday the markets only moved down 4 or 5 points, but the VIX in the last hour or so really took off to the upside. So that tells me the VIX is a little bit nervous right now with going into the month of October with very high PE ratios. We've got a key gauge coming up the end of this week with jobs numbers, and then we've got earnings kicking off the week after next. And you know, everything is lined up for the markets to go higher, but the bar is much higher too. So we got to see if the forward guidance comes in to suggest these higher PE multiples, or are we going to see it roll over just a little bit? Okay. And then, of course, if we look at the bond market is up. It's down from the middle of September, but it's found a little bit of support around the 50 EMA. I do believe the bonds will move up just a little bit higher here. We're slightly in the green, almost break even for the year for the U.S. bond market. And then, of course, if we come over here and look at currencies, if we look at the U.S. dollar, again, a very easy trade to call. No crystal ball needed here. I was calling for this thing to move much lower in this. And you could see as the dollar is moving lower, I mean, it's only a given. As we're cutting interest rates, the dollar index, which is based on an index of other currencies, the euro is about 58% of the dollar index, and the yen is about 14%, pound about 12. So those are the three major ones. When they go up, the index goes down generally. And if we look at the euro, it's going to be a little bit of an opposite picture of the dollar, right? You can see I haven't even updated it yet, but we made new intraday highs on the 25th of September for the euro. Okay. And remember what I said, the business activity across Eurozone shrank in September. The PMIs fell below 50. Some people think Germany's in a recession, so you may be saying, why is the euro up much stronger? And that is because the Feds are committed to really getting our interest rates back down much lower in a ratio to where it stands with the euro. And even if the euro falters a little bit, the euro itself is going to go up. So the dollar index is going to go down, right? And then, of course, if we look at the Japanese yen, which was our trade to go long, I got you guys long back over here back in May, and it's just taken off, right? And you could see on Friday it moved up a little bit stronger. And we'll see how it fares with the new prime minister that was elected in Japan. He is Ishiba. We'll see how he tends to be more hawkish, meaning he will be more interested in raising rates, not cutting rates. Or I'm sorry, he's more dovish actually. So we're going to see how the markets really react to him being elected. See how that thing plays itself out. But I don't see any near-time rate hikes for the Japanese at this point in time. Okay. Then, of course, if we come down here and look at gold, gold had one of those rare down days. I've got to adjust gold. You can see how gold is just completely moved up on my screen. They're up in the 30% range. No divergence here. Now, you may be saying, why is gold going up so much with interest rates going down? Well, a big reason is because of the U.S. Federal deficit, right? I think that is one of the big primary reasons for gold taking off like it is. I think we're going to have a little bit of a buy the dip opportunity coming up in October, November, and you may want to line up and be a buyer. All right. I think it will dip a little. I was expecting a dip over here, and we never did get it. And it's just, kind of rode the 50 EMA all the way up. I do believe it's got a little bit ahead of itself. It's going to dip down, and that'll be a great buying opportunity because I do see gold over 3,000, 3,400 area sometime in the 2025. And then, of course, if we come over here and look at silver, silver to gold ratio is still out of whack. I was telling our members, you could see silver made new all-time highs over here. I got a market on September 26th. My suggestion in a pair trade was to go long silver, short gold, because the ratio of silver to gold or gold to silver was way out of whack. Silver was way down here while gold was making new highs. And I said, just go long silver, short gold, and you do very well. So I know a number of folks that took the trade. Turned out to be a really good trade. I think there's still more gas in the tank for that one. Okay. If we look at copper, with China doing all that stimulus, copper loves it. It's just taken off. Remember, materials in the U.S., that sector took off. Copper is going to take off. Again, I don't know how long this stimulus is going to last. I think near term it could move up a little bit more. Okay. Then, of course, if we come down and look at oil, you're going to see oil hovering around the lows here. I think it may retest these lows. OPEC is pretty much committed to raising production, which is going to push oil, I think, even further down. Remember, my original target was right around 65, and we came down and we hit 65.27. This was my target that I put in here back in August. So I don't know if it'll get much lower than that. If it does get a little bit lower, then I'm going to, just like nat gas or just like the yen, I'm going to recommend going long. And speaking of nat gas, if we take a look at it, it is just barreling higher. Look at this. Um, and I wanted it to come down before I wanted to buy the dip, but like gold, it just didn't give me any dip to buy, right? It's taken off to the upside. And we're going to see how this thing plays itself out. I would not chase this up here, no way, no how. The trade was back down around these double bottoms down here. I was hoping it would go a little bit lower before because I wanted to go long, but I was hoping it would dip down a little bit more, but it just didn't do that. So it didn't give us the trade setup I liked, but it did go in the direction I was expecting, which is rocket ship straight up. All right, everybody, that's a real quick rundown on just some of the key markets in the U.S. this past week. Members, I'll see you this Sunday evening for our weekly market watch. We'll go into some stocks that look promising and some of these trades and maybe a good way to play the Chinese markets. All right, everybody, have a really great weekend. Enjoy the football games. Members, I'll see you Sunday evening at 7 p.m. for our weekly market watch. Ciao, folks.